Everything in this video is not a financial advice. The S&P 500, a stock market index that tracks 500 of the largest publicly traded companies in the United States, is one of the most popular investment options for individuals seeking long-term financial growth. Here, we'll delve into the benefits of investing in the S&P 500, why it's less risky compared to other investments, and what you can expect in terms of returns over time. The benefits of investing in the S&P 500. 1. Diversification. The S&P 500 represents a wide range of industries, including technology, healthcare, finance, and consumer goods. 1. This diversification helps reduce risk because the performance of one sector can offset losses in another. 2. Historical performance. Over the past century, the S&P 500 has delivered an average annual return of about 10% before inflation, approximately 7% after adjusting for inflation. 2. This makes it a compelling option for long-term investors. 3. Low-cost access. Thanks to exchange-traded funds like from Vanguard, for example. Ease of investment. The S&P 500 is easy to invest in and widely accessible. With just a brokerage account, anyone can start investing with a few clicks. Understanding the risks. Be ready for market volatility. While the S&P 500 is considered a relatively safe investment for long-term growth, it's not immune to market volatility. On occasion, the index has experienced sharp declines, such as during the 2008 financial crisis and the 2020 COVID-19 pandemic. Historically, the S&P 500 has dropped by as much as 30% or more during market downturns. However, it's crucial to remember that these drops are typically temporary. Over time, the market has always rebounded, often reaching new highs. The key is to stay invested and avoid panic selling during downturns. Long-term investors who remain patient and consistent in their investment strategy are more likely to reap the rewards. How much can you expect to earn? The average annual return of the S&P 500 is approximately 10% before inflation. While returns can vary year to year, this average provides a solid benchmark for long-term planning. Let's consider an example to illustrate potential growth. 1. Initial investment, $10,000. 2. Annual growth rate, 10% before inflation. 3. Investment period. 30 years after 30 years, your investment would grow to approximately $174,444. Dollar cost averaging. A strategy for consistent growth. Dollar cost averaging, DCA, is an investment strategy that involves consistently investing a fixed amount of money into the market at regular intervals, regardless of market conditions. This approach offers several advantages for S&P 500 investors. 1. Mitigating market timing risk. By investing regularly, you avoid the temptation to time the market, which is notoriously difficult even for professional investors. 1. Instead, you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your average cost per share over time. 2. Reducing emotional decisions. Market volatility can lead to emotional decisions like panic selling during downturns or chasing gains during upswings. 2. DCA enforces discipline by focusing on consistent contributions rather than market fluctuations. Building long-term wealth. Regular investments over a long period enable you to benefit from compounding returns, even during periods of market instability. Long-term perspective is key. Investing in the S&P 500 requires patience and a long-term perspective. While short-term volatility can be nerve-wracking, the index has historically rewarded those who stay the course. By maintaining a diversified portfolio and focusing on your long-term goals, you can navigate market fluctuations and achieve financial growth. Whether you're new to investing or a seasoned pro, the S&P 500 offers a reliable foundation for building wealth over time. With consistent contributions and a commitment to weathering market storms, you can set yourself on a path toward financial security. Actionable points. Stay on the channel to learn more about the types of exchange trade funds, broker accounts and so, but here are some actionable tips. 1. Don't wait with investment, even with a little start now, so choose a broker account where fraction shares are enabled. 2. Choose exchange trade funds that has a low cost. 3. Always read about the brokerage and make sure you own the stock or there is guaranteed insurance. 4. Use dollar cost averaging.